there's no valuation support under the stock market. There's none. Earnings are critical, but the earnings you're seeing now are so dependent on the sustainability of fiscal spending, which is, over 6 trillion. It was 4 trillion before COVID. Sustainability of that spending, sustainability of debt growth, and the sustainability of asset inflation to maintain the consumption and the margins you're seeing today, which we believe, again, very unsustainable. There's a lot of room for stocks to fall to get close to any kind of valuation that makes sense on normalized earnings.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Growth stocks have far outperformed value stocks in recent years, and similarly, large cap stocks have trounced small caps. Will that dichotomy continue, or will the pendulum finally swing back to give value and small cap investors their day in the sun? For perspective, we welcome Eric Cinnamon to the program today. Eric's the founder and CEO of Palm Valley Capital Management. Eric, thanks so much for joining us today.
Adam, it's a pleasure and I'm honored to be on your show. Thank you for having me.
Well, thank you. As I told you when I reached out to you that I got to give Dave Collum credit for putting you on my radar. You're smirking as you hear his name. Anybody who knows Dave reacts that way. He's just a completely acerbically tongued, very intelligent, very funny professor of chemistry, I believe, from Cornell.
Yes.
Very outspoken on X as well. But anyways, he DM'd me and he said, I should look into you. He said, quote, I think he's one of the most thoughtful small cap analysts and is sitting on a lot of cash, which means he shoots only when he sees the whites of their eyes. I'll give you a chance in a second to say whether that's an apt description of you or not. But one, I want to thank Dave again for putting you on my radar. And secondly, to kick things off here, since this is your very first time on the program, just answer, if you can, my general opening question I like to ask all people that I meet for the first time. What's your current assessment of the economy and the financial markets?
First, I want to thank Dave. That was very nice of him. I always enjoy his podcast, so I hope I can live up to his standards. But as far as the financial markets go and the assessment of the economy and the markets, we view things from the bottom up of the 300 small cap companies we follow that are on potential buy list. So we always view the economy, earnings trends, anything you could think of under the sun, under the financial sun. Our view comes from the companies, and what the companies are saying right now or reporting is a very mixed bag. You kind of have the have and have not economy with businesses, just like you do with consumers. Some companies are doing very well, generating record profits, record margins. Others are in recession. Consumer discretionary is not doing well. Transportation is not doing well. Employment staffing companies aren't doing well. And then there's infrastructure, defense spending, aerospace, anything tied to the build out of AI, doing very well. Higher end retail is doing well, higher end consumer. So it's a mixed bag. And when you look at things in aggregate, the economic numbers may indicate that we're in a continued expansion and it looks healthy, but from the bottom up, there's a lot of trends right now that we view as unsustainable and potentially will lead to more recession, more like a recession.
Okay. Let's see here. I want to dig into that. Maybe real quickly before we do. Your firm there, Palm Valley Capital, the little bit I know of it, it sort of strikes me as kind of like an old school value investing shop. And as I mentioned in the intro, value hasn't done great relative to growth in recent years, maybe because of some of these unsustainable trends you're talking about. But can you just give us a real quick sense of sort of how you guys approach value investing and how you see value investing in, like, where it is in the pendulum right now of Wall Street? Is it just, I've seen memes on TikTok where people say this is the best financial decision you can make, and it's a photo of somebody throwing Benjamin Graham's Intelligent Investor book in the trash. So, I mean, is it really on the outs? Are we in a totally new world, or what?
I got to get on social media. That sounds like fun. Um, yeah. So, we're an absolute return strategy. We focus on small caps. We launched in 2019. And if you think about all the trends right now in investing, active is out, value is out, small cap is out, absolute return is way out. And we decided to launch a small cap absolute value fund. So yeah, so probably not the best timing, but it's been really rewarding, been great. But I would say value for small caps, anyways, is has significantly underperformed. I mean, I don't think people realize small caps in general have not gone up in price in 4 years. It's been flat to down for small caps. Actually, it's the Russell 2000 is down over the last 4 years. S&P 500 in the same period is up 50%, and the Nasdaq 100 is up around 60%. So huge dispersion in performance, but that's relative performance. We're focused on absolute returns. So just because small caps have underperformed by that much, it doesn't mean they're cheap. It just means you have a section of the market, the mega caps, and the concentrated sectors in the S&P 500 and the Nasdaq 100 that are extremely overvalued. But again, this is in 1999. In 1999, small cap value stocks were extremely inexpensive. People were chasing technology, large cap growth. Coke and Gillette were over 50 times earnings. It wasn't just tech. A lot of the large caps are doing well. Small cap values left for dead, trading 10, 12 times earnings on normalized earnings, very consistent businesses. Those higher quality small caps today are extremely expensive in absolute terms. So while small caps are, we believe attractively priced relatively, doesn't mean they're absolute values.
Okay, and so at your firm then, what are you trying to do? Are you trying to suss out the most attractively valued small cap firms on an absolute basis, and then hope that A, those will outperform over time, and then B, hope that the small cap sector will collectively overperform the larger caps at some point as the pendulum swings back?
Yeah, well, we're absolute return focused, and for us, what that means is generating an attractive absolute return over a cycle. Uh, our goal is to achieve a 10 to 15% return on our equities. When we're unable to achieve that through that opportunity set, we talked about the 300 names earlier. Instead of being invested, just for the sake of being invested, we'll hold cash. So we'll refuse to overpay, still achieve that 10 to 15% on the equities, or we have so far. In fact, quite a bit higher than that. But what we'll do is, that cash weight can lower our returns in the near term, but will protect capital when valuations make more sense. And then we get invested once we're able to achieve our absolute return goals. And then over a cycle, it should, in theory, look pretty good. Since inception, we've achieved small cap returns slightly above. So on a relative basis, we've outperformed, but that's not our goal. But we've only been 25% invested since, over the past 5 years. So we've done it with quite a bit less risk. So you could still do well relatively in this strategy, even though that's not what we're trying to do. But over a full cycle, we want to do really well. And to do that, we believe, especially this cycle, given the valuations, that we have to be patient, because valuations for most stocks in aggregate are above or at or near past cycle peaks, bubble cycles where you lost half your money. So one of the reasons we launched in 2019, and the timing of that, was to take advantage of what we believe is going to be an extremely opportunistic period, uh, when this cycle, which we believe has been driven by many unsustainable variables, eventually ends. People will call us perma bears. We just, during COVID, we did do some buying. We got half invested. But we have not been fully invested since inception, and we may be called bearish for that. But all we're really doing is we believe in cycles. We believe in human nature. We believe in greed. We believe in fear. All we're doing, a lot of what we're doing is normalizing in our valuations. We're not extrapolating peak results by companies, and we're not getting depressed by trough results. So we're really just believers in cycles, and we tend to profit from that, or that's our goal. But of course, for a very long time, we haven't had a cycle. So it hasn't been a strategy that has been ideal for an environment where you have a perpetual bull market. But we have had events. We've had COVID, we've had higher rates for longer, tariffs recently. So there's been enough volatility, at least since inception, for us to get enough invested to where we've been able to hang in there.
Okay, so it sounds like Dave was accurate then in his comment where he says he thinks you're sitting on a lot of cash. Sounds like you are. And if you are a cycles player, I guess sitting on a lot of cash at this time makes you think that we are at a relative extreme or near a relative extreme on the valuation cycle on the overvalued side of things. Is that a fair observation?
It is fair to say we believe stocks are overvalued, significantly overvalued, and a lot of that stems from, and that's from our opportunity set. We're not making a market call just on the companies we value, and that stems we normalize earnings. You don't want to value a company on peak margins. You don't want to value them on trough margins. You want to value them on what they should earn over a full cycle, profit cycle. So because we do that. During peak margin periods, we will not be using, say right now, stocks or equities margins are 14%. Historically, they're 8. We're not going to use 14 to value these companies. We're not going to use 4 either, but we might use, say, 8 to 10. And if you use 8 to 10 right now, earnings are nowhere near where they are currently. So by normalizing, we're coming up with lower valuations than what the market is currently pricing in.
Okay. So if it's sort of a waiting game at this point in time, in other words, I mean, you are investing in the companies where you see value right now, and you've got some percentage of your portfolio that is long, but you got a lot that's sitting there in cash. What are you watching most closely here? And if you had to guess right now, what are your leading candidates on the triggers you think that would lead to some sort of, downward repricing of today's valuations?
Well, first, we do have some invested now, so we are finding some value. And I want to be clear about this: is the quality is extremely expensive in small caps and large caps. So what we really want to do, we rather fill up with quality. We don't want to buy a lot of companies with a lot of risk because we're absolute return. So we don't have a lot. We historically haven't made big mistakes, and that's very important when investing for the long term. So. So the quality side right now is not in our favor, but we are finding ideas and opportunities in companies that have operating risk or financial risk. We never combine the two because that's when you can have a goose egg. But on the operating risk, that is the volatility of cash flows. So a cyclical business, we own Heartland Express. It's a trucking company. They have quite a bit of operating risk. It's a volatile business. And then we own Flowers Foods. It's a bread. It's one of the market leaders in bread. They make Dave's Killer Bread, Wonder Bread, Simple Mills, which I really enjoy. But anyways, they have some debt though, so they have some financial risk. So we're finding names, opportunities with operating risk or financial risk, but these aren't names that are going to be big weights. We're not going to have a 4 or 5% weight on the Heartland Express, even though we like it, and a Flower Foods because of the risk. Those big weights we save for higher quality names, which again at this time are extremely expensive. You look at something like a Costco. This is large cap. I'm just bringing it up because I think people are more familiar with the Costco. 50, 60 times earnings. Wonderful business. Benefited greatly from inflation. They were able to not only maintain their margin or profits, but maintain their margins. And in an inflationary environment, that's a really big deal. But so they had a huge earnings step up, but now it's trading as if that sort of growth will continue. People are extrapolating that instead of saying, wait a minute, maybe they just benefited from this period of inflation. and that will not be perpetual. So anyways, long story short, we're about 75% cash now, T-bills. So, quite a bit, or I should say, as of last disclosure, we can only disclose what where we've been, not where we are, or where we're going. But there has been volatility recently, so I would say that you could expect us to have found a few more ideas along the way. But overall, the market remains very expensive on a normalized basis.
Okay, so I'm just going to pull on that question a little bit more, which is what right now, and I know I'm asking you to guesstimate, nobody knows, but what right now are sort of your leading contenders for what you think might start to bring valuations down? Is it tariff risk and maybe, tariff-induced price shocks? Is it just higher for longer bond yields, maybe even bond yields that continue to creep up? Is it a struggling consumer and we start seeing, just retail sales and the purchasing demand from the consumer dwindle here? Is it a full-blown recession? Like, what are the things that are on your current watch list that you think could be the most likely candidates for creating some more valuations in the future that are more attractive to
Well, Adam, I would have thought 9% inflation would have done it.
you?
And the delayed response by the Fed. But a lot of the risks you mentioned are all valid, and it's one of the reasons we apply a risk premium for owning equities. It should have a higher return than risk-free rates, and you're not seeing that right now. If you look at the Schiller PE right now, it's 37 times, second highest ever behind the tech bubble. We haven't had a recession in 10 years besides COVID, so the Schiller PE really isn't even normalized. It's 10 years of expansion, so that's abnormal. So even using that number is insane. And then you have price to sales now 3 times on the S&P 500. Historic bubbles have peaked around 2. Market cap to GDP over 200% now. Past bubble peaks 100, 150%. So all these valuation metrics suggest we're in an extremely rare territory as far as valuations go. But what causes that valuation excess to revert or even go below normal is unknowable. But many of the things you mentioned, I think, are leading candidates. Underestimating inflation is obviously one. Letting it run too hot for too long. The debt obviously is unsustainable. We believe. I mean, I think a lot of people believe that. The fiscal deficits, if you look at profits right now, they're almost perfectly correlated to government debt growth and fiscal deficits. I think people underestimate the power fiscal deficits and government debt growth have had on earnings, just like they
Mhm.
did in the mortgage debt bubble. Mortgage debt went from 7 trillion to 14 trillion. Government debt's gone from 10 trillion to 36 trillion this cycle. So a tremendous amount of credit's been created through government debt, and its profits have followed. So it's sort of a cycle right now where you have fiscal deficits plus asset inflation equals record profits equals buybacks, which I'd love to talk about, equals higher stock prices, and it's a cycle, and then it just goes around and around, and everything looks good right now as long as things stay. And not perpetual, as long as things are sustained, and there are cracks, but I would also argue, again, like, I was joking earlier about 9% inflation. Those were cracks too. And we've seemed to keep going, finding ways to keep the cycle going. So it's been an impressive a cycle. There's no denying that. They've done a really good job of keeping it together.
Um, okay, so a lot of this comes down to, use a word you picked there, sustainability, right? Um, and a lot of talk right now about the unsustainability of the debt. I just know that people have been warning about that for decades. I agree that it is unsustainable. I just have gotten to the point where we just do not know when that breaking point is. Is it 36 trillion? Is it 46 trillion? Is it 66 trillion? Who knows? So that's a hard one to use as a timing perspective. But there are a couple of things you mentioned there. So one obviously is fiscal spending, which continues, at a very high rate. Now there is a lot of lip service in this current administration that they want to kind of get that reined in. Um, who knows if they will or not. I will note that from a monetary side, we have had some restraint there, right, over the past, 2 years or whatever, right? Um, so the monetary spigot sort of got turned off. Monetary stimulus spigot got turned off, and it hasn't really mattered all that much yet, at least.
Well, you know why, Adam? I mean, you know why that hasn't mattered? Because investors know, they know the Fed will come back at any moment to the rescue, just like they did when, the banks started unraveling a couple of years ago.
Hmm.
They'll be there. Everyone talks about Taco, about, yeah, Trump always chickening out. We call it FACO. The Fed always chickens out. They will be there as soon as they're stressed in the market, spreads widen, or we have a failed treasury auction. I promise you, the Fed will be there to backstop the markets. So even though they haven't, really didn't raise rates too much, and they have ended QE, they'll be back. And I think the markets know that. And I think that's why asset prices or inflation have held up so well in the face of many uncertainties. Um, so yeah, it's kind of I in a blog post I wrote about the market's paddle. There used to be a time when the market would Mr. Market would paddle you when you did some badly timed investments or made some bad decisions. It was a disciplinary, it helped the markets. But now it's the Fed has the paddle, and if you don't play along, you get the beating. So I just think knowing that there's that Fed put is what keeps a lot of this together, and the Fed will be back. And then you have to kind of take a few steps forward when they come back, just like when they cut rates by 100 basis points uh, not too long ago. What's going to happen to the bond market, and do rates actually go up? So that will be interesting. I just want to fast forward to that point. Let's get it over with. I would love the Fed to cut rates to zero tomorrow, and we could just find out how the market would respond. So, but they'll be back.
All right, so that's obviously one support that well, the market is continuing to count on, as you just said. Another one is beyond just the monetary and the fiscal side is the corporate side, which you said the buybacks, right? Which is they have grown, some would say metastasized to just a gargantuan level. And we can really see in near-term market trends when we enter a buyback window, blackout window, and then when it reopens back up, just the upward lifting effect that buybacks have on these asset prices. You said that was something you were interested in talking about. So what is it specifically about buybacks that you want this audience to know about?
Um, just how large they are, and how big of an impact they have on the stocks. The ones we trade, even, we notice the ones that have buybacks and the ones that don't, how they act, how they trade. Buybacks now are, approaching, if not exceeding, a trillion. Is it a trillion? I think it is a trillion now a year. And there's a lot of talk about passive and how much passive has influenced stock prices. Buybacks are 2 to 3 times as large as passive net flows. So these are another set of price insensitive buyers. They don't really, they'll pay lip service to it, but they don't really care. If they have a certain amount allocated to buybacks, they're gonna gradually buy that back during the periods that they're allowed to. You look at something like an Apple. They have a huge buyback. It's $100 billion relative to its market cap. It's really not that great. It's about 3%, but they also benefit from the passive flows.
Right.
So I think the where you want to be if you're a short-term trader, or maybe you're developing an algo that likes to front run, you want to be in stocks that have buybacks and get the passive flows, because now you have two price insensitive buyers. And I think that's one of the reasons the large caps have done quite a bit better, is they're benefiting from the passive and the buybacks, where the small caps have not are not getting the passive flows. So you actually have to, fundamentals. You have to do the work, and you have to earn it the hard way. You're not getting that passive flow. And on small caps as well, earnings have been declining now for 2 years, at least on the benchmark we use, and a lot of the companies we see. The mega caps haven't had that, and a lot of that has to do with the huge AI spending. but small cap earnings have rolled over from the peak of 21, 22. So they're not with the profits rolling over, they're not getting the passive. Now a lot of them aren't doing the buybacks. And then you wonder why they haven't done anything in 4 years. So a lot of it is flows, and we see it with the companies we follow, and the ones we own even, when if they ever stop buying back stock, like you just don't even say it. Because if you say we're done with buybacks, it's like it's game over. The is not going to do well. So it's very interesting. And when we trade, we trade quite a bit in these small cap stocks. Um, it's like you're always fighting these little algos. Like there might be a lot of volume in some of these names, but there's not a lot of liquidity, if that makes sense. So you have these little tiny trades going on. I have no data supporting this, but I don't believe, like, I wrote a blog post called Prices Aren't Real. It just feels like when you're actually in a market, you have a block, you want to buy or sell, there's no one there. And that is from the growth of passive. Passive now is bigger than active. And so there aren't the blocks there used to be. So you'll see stocks with good volume, but when you go to buy or sell, like, whoa, it's like crickets. I'm not trying to sell 14 shares. If I was, it would be quite a bit easier. But that's what's being traded right now. And I know I just went on a totally different subject, but I think that's important too. But the buybacks are part of that liquidity equation because they're a known buyer. They don't really care about price, and they're always, not always, but often there during certain periods. And the passive is another monster that seems to always be there as long as the flows keep flowing.
Okay. And again, for folks watching who have watched previous videos here on this channel, the passive flows that Eric is talking about, this is the giant mindless robot that Mike Green talks an awful lot about. So I won't.
Which fluctuate, but I think the last time we looked, we're about 2 to 300 billion. It might be closer to 400 now because I know they've picked up recently. Where buybacks, again, are closer to a trillion. So two pretty big, buy price insensitive buyers on a total market cap. What is it now? 60 trillion for stocks, maybe 70, depending on what you use. So it's not huge when you think of it from that perspective, but as an incremental buyer, and if you don't care about price, it's a big deal.
Well, you have to remember that stocks are priced at the margin, right?
Yes.
And so if the dominant marginal buyer every month after month is a price insensitive buyer, as you're saying here, that does add a lot of continued upward price pressure. So let me ask you a couple rapid fire questions coming out of this. So first off, just on buybacks specifically, just want to get your opinion. They used to be illegal. They were considered price manipulation. What is your opinion on buybacks? Should they be allowed, or is it just gimmickry?
I used to love buybacks, and they just weren't this pervasive. But somewhere along the line, they went from buying a stock at a discount, just like an active investor would try to do, to that consistent bid, uh, and the valuation sensitivity went away somewhere down the line, and it no longer went from trying to increase the intrinsic value per share of a business to just having a buyback, and just keep cranking up the stock, and a lot of that, of course, is tied to executive compensation.
That's where I was going to go,
Um,
where it's really in their interests more than it is the actual shareholders, right?
for sure. And I can't tell you how many companies we've seen spend millions of dollars on buybacks and then eventually need that capital. I mean, badly. Big Lots is a good example where they recently went bankrupt. There's going to be a lot of consumer discretionary companies that did extremely well in 2001, I mean, 21 and 22, due to all the COVID stimulus. Earnings were booming. And what they do with the money? Instead of setting it aside for a rainy day fund, which you would think after COVID, companies would realize they needed, um, instead of that, they bought back stock. We have so many consumer discretionary names we follow that the stocks are down 30, 40, 50, even more percent, to where they could almost go private right now if they had kept the capital from buybacks.
Mhm.
And unfortunately, a lot of these are going to go bankrupt. And if they didn't buy back, and then the CEOs will lose their jobs, and some have already. But they did very well in their
They are
stock,
they already
during
padded
that
their
period.
pockets.
But
Yeah,
they don't,
and
there's no clawback on buybacks, and there's no write-offs on buybacks. So there should be. So another blog post we wrote was the buyback wall of shame, and I think when the cycle ends, there's going to be quite a few more that join big lots.
Is this somewhat similar to on the private equity side when, you do a big LBO of a corporation, you saddle it with a bunch of debt, and
Yes. Yes.
basically you're just hollowing out the company, right? Because everything's
Yes.
going to pay the debt, and then the private equity firm flips the company at some point in time, and they made out like bandits, but you got this shell of what was there before.
Very similar. And you have the investors encouraging them to do it. So we're not all we could all share some of the blame. When I say all, and I'm just including investors. You in these conference calls, uh, a lot of these analysts are encouraging them to buy back stock. And maybe if you trade through our desk, that's even better.
Hmm.
But no, no. We're all kind of in this together. Buybacks have helped this market considerably. So it hasn't just been executives that have benefited. It's been many of the funds and investors that invest in basic ETFs.
Okay. So let me ask you this then. I talked about the folks that are throwing away Benjamin Graham's book. Um, what would you say to them? Like, why take the value route here? Why not just learn to love the bomb? Just let liquidity work for you. And yeah, I'm going to buy these large cap names that are doing massive buybacks and just let this thing run for me.
I don't know what I would advise them. The cycle's gone on so long that we acknowledge that we could be wrong, and the Federal Reserve could continue to monetize debt without consequence. It could keep everything elevated, inflated for an extended period, but we don't believe that. But we're aware that it could happen. So we don't want to tell everyone, get out of whatever you're in and get into our fund because maybe we're wrong. It's possible. We don't. I mean, we certainly don't believe that. But I would go back to just past history. This isn't new. The only thing that's new is just kind of this is a really long cycle, so it's a little different. And the intrusiveness of the central bankers, this is new. I mean, they didn't used to print money to buy bonds and corporate bonds even, and who knows if they'll buy stock next. Um, so in that regard, it's different. But if you look back in history, not one cycle in the history of mankind has been sustained. It's always ends, especially cycles driven on credit, which most are, and this one is. But people believe, I think, that are fully invested now, that they'll be the ones that identify the turn and they'll be able to get out. And we always get asked, why should I pay you to be in cash? And we just say, you don't have to. You don't have to buy a fund. But we always say it's usually self-evident after a cycle ends why you would do that. And that's protect capital and then get aggressive and opportunistic. You can't when things are crashing, you can't. It's hard to sell things and buy things. And you really need that liquidity. So you go back to 1999, 2000. We had that same feeling as we have today that it'll never end, and investors are euphoric. There really wasn't a bell that rung. In March of 2000, I remember just coming to work, and one day everything changed, and the internet stocks were crashing. Instead of going up 10% a day, they were just getting destroyed. Um, and I don't know if there's enough investors that either remember that or appreciate it, or just how quickly things can change without a catalyst. See, everyone's looking for a catalyst. In market cycles, you don't always need one. I mean, the housing bubble is different. I think we did have catalysts. You had Bear Stearns going bankrupt, and you had mortgage credit growth start to slow, which was driving everything. Um, so that you did. I remember '07, you could see earnings starting to roll over. So you had almost a year to prepare for that one. But we're not all. This isn't. a catalyst or a bell doesn't have to ring. I think that's important for investors to understand.
Okay. Well, so that gets to the question of, again, catalysts. And if I took good notes here, really the thing that determines pricing in a market, even one that's as, maybe not as traditionally priced as the market is now, is earnings, right? And so if earnings outlooks get compromised, prices will have to get adjust accordingly. So I want to read just a section here from a recent post that you guys put up at your website, which was titled "It's Affordability Stupid." And here was there are a lot of great points in there, but here's one sort of high level section I wanted to pull out here. While macro data may point to an economy that appears resilient, with moderate nominal growth, low unemployment, and steady consumer spending, beneath the surface, an affordability crisis is building. Though it may spare those with inflated assets, it is marginalizing and demoralizing a vital portion of the US population. It's another unsustainable trend built on years of easy money and an overemphasis on financial stability, i.e., keeping asset prices inflated. Like stock valuations, corporate profit margins, and government debt, we believe today's affordability trends are overstretched and will inevitably break. So let's dig into that if we can. Can you talk specifically about the affordability crisis that you see here?
Yeah, and again, we always look at things from the bottom up. Cracker Barrel just announced earnings, I think it was a week or two ago, and they announced positive comps of 1%. And the stock was up. I mean, it was up big on. I mean, it was up like 10% because that was a big deal because these kind of middle end restaurants, they haven't been performing very well. So positive comps was really great. But beneath the surface, pricing was up 6%. So you've got mid single digit negative growth in traffic, and so you're raising prices. Your earnings are at least stabilizing, maybe improving, but you're pricing out a certain percentage of the population. And this is a really big trend right now in corporate America, the premiumization strategy, which is to sell to the affluent, the higher end. I mean, even I mean, I'm sure you've read this or seen this, that even the dollar stores are benefiting from selling to higher end consumers now.
Hmm.
So the more you price out, are we going to price out the lower middle class from going out to eat? I mean, if this continues, that's what you're doing, and it may benefit profits, but what does it do to society? Um, and again, we go back to sustainability of the cycle. I just don't think this is a sustainable trend. Look at the airlines right now. They're tearing out a lot of the economy seats and replacing them with business class and first class. So are we eventually going to make air travel affordable for the affluent only? I mean, I know that's extreme, but that's just a good example of what the businesses are doing now. They've learned that they can make more by doing less. And a lot of that came from COVID. You had all the asset inflation from COVID, but you also had supply constraints. Companies were having difficulty meeting demand. And eventually they learned, well, let's just not meet demand. Let's just raise prices. And it's okay losing the lower end. And promotions, were taken away. My one of my favorite hobbies is BOGO shopping. The BOGOs were taken away, and yeah, so you're intentionally taking away from a large percentage of the population, but not a large percentage of the population that has wealth or accumulated wealth. So it's a dispersion or disparity, the wealth inequality trend that continues to build. And at some point, where do we end up there? I mean, and that trend is not going away on the corporate side. That is a very popular trend that we expect, as long as asset prices remain inflated, to continue. And then real quick, Adam, like Toll Brothers is a great example. They're known for the higher end homes. So they're kind of pricing everyone out to begin with. Their average home is around $1 million. But what's interesting is in their commentary, they talk about how higher interest rates really haven't affected them, because their average customer has so much wealth. They'll either buy the house for cash, almost a third or so do that, um, or just they have huge down payments. It's not a big deal. But what is a big deal to Toll Brothers, and I'm not sure they fully appreciate it, is the stock market. So as all these companies like the airlines start to gravitate towards this premiumizing their services or goods and services, they're really setting themselves up to be maybe too dependent on volatile asset prices, which
Hmm.
have gone up for so long that maybe the perception is they'll never go down, and we can position ourselves this way because uh, this is going to be sustained. It's a new plateau.
Let me actually pull right on that directly. So, as the economy becomes more and more dependent on a smaller and smaller percentage of the population that has more and more of the assets, right? Most recent stat I read, this is now old, it's probably even worse now, but I think it was 93% of all financial assets were owned by the top 10% of households, right?
Mhm.
So already highly concentrated. To your point, that works great right up until your affluent consumer starts tightening their own belt, right? So to your point about the stock market, should the stock market correct, well, who is that going to hurt disproportionately? It's going to hurt that 10% that owns 93% of all the financial assets, right?
Yeah.
So if all of a sudden those folks that you're depending on to just keep buying more and more and more, all of a sudden cut their spending by 20%, a third, half, whatever, depending upon how bad a market correction you might have. You got a huge, an increasing part of the corporate fleet that is dedicated to those people.
Yes.
Yeah.
Yes, and we're seeing that from the bottom up. And then the flip side, the argument for asset inflation or growing the economy through wealth, the wealth effect is, well, look at how low unemployment is, 4%. So that's really good. But what if you price all of these workers out of basic necessities? They can't afford homes. I was getting my hair cut, and the lady was telling me about how she was so frustrated that she'll never be able to afford a home. So instead of saving for a home, She went to London on vacation.
Hmm. Yep.
So I
Yeah.
think you're
Doom
reaching a
spending.
point
Yeah.
where cut your own hair. Um, you can't just give half the population everything, um, and reward them for what? Just owning overvalued stocks. You're not
Yeah.
really. People will say, "Oh, I earned it." Well, I don't know. Did you
Well,
did
you
you
had a
earn
lot of
that
help because the system becomes
multiple going
dependent
from?
on higher prices. And so it's
Yeah,
always trying to engineer higher prices to benefit.
yeah,
It reminds me a lot of when I lived in Manhattan. I started my career as a junior investment banker on Wall Street, and there was this narrative in Manhattan that I think has only continued, which is, well, we have to pay the bankers well, right? Global financial crisis, right? 2009, right? A lot of good arguments that there's these big banks and their reckless lending policies that really engineered that crisis. And yet, in the depth of the great financial crisis, they paid themselves record bonuses in 2009,
yes,
right? And
yes,
the rationale was, well, we can't pull their bonuses because they're such big spenders in Manhattan. Everybody depends upon what they spend, right? And it's kind of like, who anointed these guys the untouchable
yes.
kings, right?
That's right. That's right. But the market's gotten so big, asset prices are so high. Um, it is now, a threat to the system. If stocks were to decline 50% from here, what would happen? It's the classic too big to fail. Um, but I know you're a fan too, but I love James Grant, and I think one of his famous quotes is, why don't we just try capitalism?
Yeah, I know. Creative destruction. Yeah.
And free markets, I mean, let's let it rip. Let's let it do its thing. But every time we get close to letting capitalism or free markets cleanse the system, get rid of the malinvestment, what do we have? We have the Fed come in with their heavy hand and bail everyone out, and the rich, get to fly first class, and the not so fortunate, um, maybe don't even get to fly now.
They
So
don't even get to
yeah,
fly.
it's
Yeah,
it's a
and
trend. It's a trend we're seeing, and I hope it corrects itself without a significant correction in the markets. I'm not sure how that all unfolds.
I was gonna say, I don't think you've got confidence that it will, right? It seems to me you're betting your money on in your 70% T-bill position as you think it's going to be something a little more painful.
We think this all is going to end. The deficits, the asset inflation, which are driving corporate profits, which are driving stock prices, it's all going to end. And that's one of the reasons we launched. We launched in 2019. It's been over 5 years, but we wanted to have a strategy to be able to take advantage of what we believe are going to be very large opportunities. The numbers are so much bigger this cycle as far as debt goes, all of the spending. Um, so we think the opportunities will be that much bigger. And the opportunities were wonderful in 2009 if you had the liquidity.
So sorry to interrupt you here, but let me ask you this. So back in 2019, I could have had a similar discussion with you about how there were a lot of unsustainable trends, that market valuations were pretty rich, and that a strategy like you're talking about could work pretty well, right? A value-based strategy of let's wait for the correction and then let's deploy and buy really good quality companies at really attractive valuations. What you didn't anticipate, and it's no fault on you, nobody could have seen it coming, was COVID and the gargantuan amount of trillions in stimulus, both monetary and fiscal, that were unleashed, right? So I guess kudos to you and your firm for staying alive through that,
Right.
because that was the complete,
Half the
like if you
battle.
said, what's the worst thing that could happen to our thesis? That might have been, right? Okay, so now we're on this side.
Real quick,
And
Adam, COVID actually helped us, and that's not the catalyst we wanted. But small caps during COVID collapsed 40%. And we were able to get half the strategy invested. We're actually up 19, 20% in 2020. So that was I mean, obviously not a catalyst we wanted, but it was a catalyst of volatility nonetheless. So this strategy can weave around even though we haven't had we call it the main event. There's been moments over the past 5 years. Higher for longer was another one in October 23, and then tariffs as well. But still, this isn't anything like what we expect will eventually happen.
okay, and that's where I was going, which is kind of the main part of your thesis hasn't happened yet, but now with the dust settling, mix all my metaphors here, the pig largely through the python, you are now saying, okay, we're kind of back to where we were, where we've got richly valued markets, maybe richly overvalued markets. We've got value stocks and small caps out of favor, not necessarily cheap, as you were saying earlier, but out of favor. But the risks in your mind, I think, here substantially outweigh the rewards. Hence, you're sitting on dry powder, and you're going to more or less find opportunity where you can in the interim, but wait for that main
Yes.
event and then deploy.
Yes.
Okay.
It's good. Good summary.
So as we start to wrap up here, just as you look into your crystal ball, let's just next year, 6 months. Feel free to go out 12 months if you want, but what's your general expectation from the market here?
It'll be interesting. Earnings are going to be interesting. Things did slow down in Q1. I know there's not as much concern about tariffs because it hasn't been showing up in the CPI, but a lot of the companies we follow have 90 to 120 days of inventory. A lot of them are waiting to see what happens before making a decision on pricing. That's eventually going to flow through. It's going to be shared. It's not going to be stuck all in the consumer. The vendors, the manufacturers, distributors, they're all gonna take a cut. They'll try to reduce costs and productivity as well. But that's probably going to show up later this year, Q3, Q4, how companies respond to that, and then how consumers react to that. And from what we're seeing, half of the population is not going to react well to that if inflation picks back up, while the other half won't care
Hmm.
as long as the S&P 500 and the Nasdaq the QQQs stay where they are. So it's again, all these trends continue to get stretched, When any of them snap, we don't know whether that will be the bond market or even the stock market could correct without warning. Because again, Adam, there's no valuation support under the stock market. There's none. Stocks go down 5% on tariffs. I mean, that's not really. Now you go from a Schiller 37 to 36 PE. Now your earnings yield is 2.7%. Or 2.8% instead of 2.7, and the risk-free rate's at 4.4 on the 10-year. There's a lot of room for stocks to fall to get close to any kind of valuation that makes sense on normalized earnings. And I would say one of the main points we would like to make is earnings are critical, but the earnings you're seeing now are so dependent on the sustainability of fiscal spending, which is, over 6 trillion. This was 4 trillion before COVID. Sustainability of that spending, sustainability of debt growth, and the sustainability of asset inflation to maintain the consumption and the margins you're seeing today, which we believe, again, very unsustainable. I had a friend real quick, I know we're running up against time, but he was a big proponent of balancing the budget, the fiscal deficits. He's like, this is a big bill. This should be, the spending should be cut. And I know him well, and I know how he's positioned. His investments are positioned, which is highly inequities. And I said, well, if we balance our budget, corporate profits are going to tank, and you're going to lose a lot of money. But it's easy to talk about deficits, but I don't know if everyone's really connected all the dots of how much we're spending and how much that's impacted corporate profits. Again, pull up a chart of the fiscal deficits or the government spending and the government debt growth and put it next to corporate profits. It's almost perfect correlation.
Yeah, yeah. I know that's been very true. And to your point, kind of too big to fail. It's like, have the deficits become too big to cut, right? Because the market is so
Yes.
dependent on it, right? All right. Well, look, Eric, great talking with you. I'm going to send Dave Collum a note of thanks for connecting us here. So what I hear you basically saying, and this is not unfamiliar territory. I've had lots of discussions like this, is that there's sort of a sword of Damocles that is hanging over this market, right? Which is the high level of overvaluation. As you said, there's not a lot of valuation support under stock prices today. So for a whole bunch of reasons that we've discussed, that thread that is holding the sword looks like it's unraveling. Thing is, we don't know when that's really going to break, right? So it could be tomorrow, it could be 5 years from now, right? We don't know. It's going to be dependent upon a crazy amount of factors that we can't project out with confidence here. So first off, I'd like to just tell you, hey, I'd love to have you back on the program again in the future, so you can kind of give us an audible call about where things are in terms of your outlook. And obviously, if you get to a point where you say, hey, we now think that thread supporting that sword is about to break for reasons X, Y, or Z, let me know. We'll get you back on the program swiftly.
Yeah. And it's interesting you bring that up about the sword over our heads. And throwing away, Benjamin Graham's book. Maybe it's a good time to have a margin of safety.
Yeah, absolutely. Well, I think I've made this call, but I'll make it again here, which is I'm going to predict that at some point in the not terribly distant future, there's going to be a trend on TikTok saying, hey, the most useful bit of financial advice you can now get is to reach in the garbage can and pull that book back out.
Don't throw it away.
Yeah. All right. Well, look, for folks that have enjoyed this conversation, I'm guessing for many, it's the first time that they've been introduced to you and your thinking. Where can they follow you and your work between now and the next time you come on this channel?
We're at palmvalleycapital.com, and we write a blog every month. And Jamie Wiggins, the co-founder, he writes an incredible quarterly letter. So just check us out, and hopefully you find it at least interesting.
All right. And you were very kind when we when we got on before we turned the camera on and told me that you had actually been a listener of this channel, which was wonderful to hear. But that specifically you listen to it when you're making spaghetti for your family on spaghetti nights. So hopefully when this comes out, you can maybe listen to it while you're making your next meal.
That'll be kind of weird. I don't know.
All right. Well,
But
look,
I
folks.
appreciate it, Adam. I really enjoy your show.
Well, that is very kind of you to say, and I'm so glad that you came on when I decided, were willing to come on when I called you out of the blue there. All right, well, look, folks, if you have enjoyed this conversation with Eric, please show him that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Folks, if you don't yet subscribe to this channel, there's lots of reasons to do so. An important one is if you want to make sure you don't miss an episode, if you subscribe, that's how you get alerted when new videos go out. But we are getting into the summer months. Those of you who might remember, I did this last summer. My birthday is at the end of July, and I would love to close out the month at an important milestone. Last year, we crossed 100,000 subscribers. This year, trying to get to 150,000 subscribers by the end of July. So if you are watching this and have yet to subscribe to this channel, please do make sure you hit that subscribe button down there. Also, if you are took good notes here with Eric and think are like-minded with him and would like to try to figure out how to navigate your financial wealth through what might lie ahead, especially if we end up having some sort of large corrective event like Eric thinks could happen here. Highly recommend you get that help from a good professional financial advisor. Importantly, one that takes into account all the macro issues that Eric has talked about with us here. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you'd even just like a second opinion from one who meets that criteria, then consider scheduling a free consultation with one of the financial advisory firms endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. To schedule one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple of seconds to fill out the form. These consultations are totally free. There's no commitment to work with these firms. It's just a service they offer to try to be as helpful as they can. Eric, again, thanks so much, my friend. I really appreciate getting to know you here initially. Looking forward to some future discussions with you here to dig a little bit more deeply into your approach and your outlook. But for folks who watch this channel, and most of them are just regular people trying to grow their wealth prudently, but most importantly, trying not to lose it all in some market event like you're afraid could happen here. Do you have any parting bits of advice for them?
Think independently. Sometimes trusting your gut's not a bad thing, and if you believe stocks are overvalued, you don't have to be investing. You don't always have to be doing something in investing. Sometimes waiting it out, or if you're not sure, if you're uncertain, don't feel forced to do something.
That's very well said. And I say this from time to time with the financial advisors that come on this program. One of the reasons why I pick them, folks, I have them here just to serve as models, right? To say, look, I think you should look for a good financial advisor. People say, well, what does that look like? So I bring them on and say, look, I think these guys are good. Feel free to talk to them or find somebody even better than them, right? But I'm trying to establish a benchmark. And one of the things that I look for in those firms is their willingness at times to say, hey, look, we don't like the risk return of the market right now, and we are more in cash or T-bills than we normally are. And a lot of financial advisors won't want to admit that or won't even want to do it because they
No.
think, well, my clients could be in T-bills on their own. And if I tell them
Yes.
that I'm in cash, they're just going to say, well,
Yes.
what do I need you for, right? And the thing I remind people of is you want to pay for the expertise of when to be in cash and when not to be in cash, right? You're nodding,
And
saying
Adam,
yes.
it's an important part of the strategy that we really didn't touch on, but and why no one really does it anymore. This old school way of investing is there's just too much career risk. Um, so if we stay invested this way for too long, we could lose all of our assets. So a lot of people just will never do this. And I've worked for some large firms and other firms throughout my career, and some good ones. But in the industry overall has tilted so much to relative that this way of thinking and investing, it's not just old school. It's just too risky from a business perspective, not an investment perspective, which I think we carry quite a bit less risk. But from a business perspective, it's too much risk for many to handle.
Yeah, it's crazy. So this is obviously I'm taking notes on what we'll talk about the next time you appear on
Yeah,
here. We have all these, you hear the term malinvestment. I think we have a lot of malincentives in the financial
oh,
system right now, and that's a
no,
good
no
example of
doubt,
one.
no doubt. Yeah, agree 100%.
All right. Well, I've really very much enjoyed this, Eric. Thanks so much. Look forward to having you back on in the future. Really appreciate it.
Thanks, Adam. I appreciate it.
All
Take
right. And
care.
everybody else, thanks so much for watching.
If bonds are getting inflated, if real estate is getting inflated, in the CP lie, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent of what it's insane is what the CP lie is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. The M2 is probably, and it ended up right in the middle. And so, yeah. So $1,000 silver is possible. I doubt it, but triple digits, I think that's a slam dunk, like I've said many times. And so silver is incredibly undervalued right now.
Recent analysis suggests that gold could reach $12,000 per ounce, mirroring the speculative surge seen in 1980. However, such a scenario requires a significant global crisis or a major shift in monetary policy. Currently, gold is trading at approximately $3,500 per ounce, indicating a substantial gap to this projected high. As for silver, while reaching $1,000 per ounce appears highly improbable, the metal is considered undervalued. Factors such as increasing industrial demand, particularly in electronics and renewable energy sectors, along with a widening gold-to-silver ratio, suggest potential for price appreciation. Mike Maloney, a well-known precious metals expert, author, and economic educator, highlights that gold has historically preserved purchasing power, but it also experiences bubbles, something it's not in yet. Compared to past decades, gold now buys far more stocks and real estate. Both gold and silver remain undervalued, with silver especially lagging behind even inflation-adjusted levels. Gold's popularity has rebounded to 23%, still below its 2011 peak of 34% after the 2008 crisis. Unlike 2011, today's volatility stems from policy and market factors rather than systemic threats. The World Gold Council reports that central banks purchased a record 1,037 tons of gold in 2024, continuing a multi-year trend of official sector buying. Silver prices in 2025 are expected to follow a steady upward trend, with a notable acceleration in the fourth quarter, during which December could see highs of $42.44. This growth may be driven by increased industrial demand amid global energy transitions and supply chain constraints. Investors are likely to view silver as a strategic hedge, particularly in light of ongoing geopolitical uncertainty and persistent inflationary pressures. Both gold and silver are experiencing notable market dynamics, influenced by macroeconomic factors and investor sentiment. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
Well, yeah, he's the great hedge to maintain purchasing power is true over the centuries, but there are times when it goes into bubbles, and it's not in a bubble yet. If you want to increase, if it were true that it has only kept up with inflation, then right now the Dow Gold is at like 12 to 1, and it was 45 in 1999, 2000. I believe it was like 38 when I first started investing. So I can buy like 3 times more stocks with my gold. I can buy a whole lot more real estate with my gold and silver than I could back then. So it's gaining in purchasing power if you're buying it at the right time, because it goes through these overvaluations and undervaluations. And when you measure it against, decades of history, what you see is that we are still in a severely undervalued state right now. So it's gold and silver. Gold, if you use the CP lie, yes, it's corrected against inflation. Exactly. That's what causes a peak, is everybody trying to rush into it at the same time. And what we are actually seeing in the retail sector is low sales volumes right now. The public is still like yawning when it comes to gold and silver, and they're chasing the stock market right now, which is the Buffett indicator is just in insane valuations. When this next crisis happens, it's going to be one of the worst that has ever happened because there's so many things are just so skewed. But what's interesting here is you have the shadow stats CPI, also called the shadow stats alternate CPI. Now, a lot of people think, oh, well, that's just some nut putting together. No, John Williams was an insurance actuary. And in the mid 80s, all of his models stopped working. And he was wondering why. And he started researching it. And then he found that the government was changing the way that they calculate inflation. They kept on messing with the CPI. And he went back and what he uses for this alternate CPI is the government numbers from World War II to 1982, the method that the US government used to calculate inflation. So these are both sets of government numbers. One of them keeps on getting massaged periodically anytime the CPI is coming in too hot and it makes the administration look bad. It seems to get adjusted. So what have you got there? I've always said also that the truth probably lies somewhere in the middle. But these are two sets of government CPI numbers. And one of them is adjusted to sort of cheat Social Security recipients out of their full, they don't keep up with the true cost of living. And all you have to do is, if you look at the CPI and look at your personal purchasing power, where it has gone, and prices, go to a restaurant. I've been traveling. You order a hamburger and a beer in a airport. Oh my God, it's just unbelievable. So, yeah, gold and silver have not kept up with true inflation, the inflation that you experience day to day. So I believe that the truth lies between those numbers. But gold is nowhere near being in a bubble. And so it shows that it should be, if the green government CPI was true, then gold would be in a bubble, which would mean it would be of a large percentage of global financial assets, that it would be on the news everywhere, that every financial planner would be recommending put 30% into, what's interesting, nobody recommended gold back in the 70s until the last, all the financial planners switched to recommending gold. Put 10, 20, 30, 40% into your portfolio after the peak in 1980. And there's a movie called Brewster's Millions with John Candy and Richard Pryor. And Richard Pryor is going to inherit a whole bunch of, it's like $33 million or something like that.
Gold and the US dollar typically exhibit an inverse relationship. When the dollar strengthens, gold prices often decline, and vice versa. This dynamic is primarily due to gold being priced in dollars. A stronger dollar makes gold more expensive for holders of other currencies, reducing demand and thereby lowering its price. However, recent market conditions have highlighted a more complex interplay between these two assets. As of August 14, 2025, gold prices extended their rise for a third consecutive session, bolstered by increasing expectations of a U.S. Federal Reserve interest rate cut and a weaker dollar. Spot gold edged up to $3,357.65 per ounce, while the dollar remained near multi-week lows, aiding gold's appeal. Ongoing conflicts, such as the Russia-Ukraine war, have driven investors to seek safe haven assets like gold, even when the dollar is strong. global central banks, particularly in Asia, have been increasing their gold reserves to diversify away from dollar-denominated assets, providing steady support for gold prices despite the US dollar's strength. Persistent inflation has kept gold attractive as a hedge, even in a strong dollar environment. The dollar's decline boosts gold's purchasing power. Mike believes silver reaching $100 to $200 is inevitable. Historically, silver has experienced significant price surges during periods of high demand and limited supply. While reaching $200 per ounce would represent a substantial increase from current levels, silver has surged in 2025, reaching multi-year highs, driven by strong demand and safe haven buying amid global economic and geopolitical tensions. Major financial institutions, including HSBC, Citigroup, and Bank of America, have raised their price forecasts, citing tightening supply and robust demand. When gold hits around $5,000 an ounce, investors may shift to silver just as they did in 1979. Despite these gains, experts like Michael Oliver consider silver undervalued and see potential for significant upside. Market dynamics, including industrial demand and limited supply, support continued growth. However, investors should remain mindful of potential volatility. Now, let's memorize the interview.
Pretty nicely, sort of where it feels like it should be, which is, below halfway, but certainly not at the bottom of the valuation channel.
Right. And what's interesting here is that it's actually closer to the shadow stats line than it would have been to the CPI line. And M2 is basically where all of the dollars, this is the dollars that get created by the banks and the Federal Reserve. And they go out into the economy. So this is covering true inflation. This is also covering the inflation of the stock market. If bonds are getting inflated, if real estate is getting inflated, in the CPI, they decided that you don't actually own your home, you rent from yourself. So it's a rental equivalent. It's insane is what the CPI is. But this sort of corroborates what I was saying, that the truth lies somewhere in the middle. $12,000, that is actually a reasonable target if gold goes into the same type of bubble that it was in back in 1980. We don't have lines at coin shops. We don't have it in every newspaper's headline. It's not on the news every hour. It isn't dominating, and it will. There will come a day where it dominates the news cycle. Adjusting it compared to all these other financial assets, and it's what percentage change did real estate, the stock market, the 10-year treasury, GDP, currency in circulation, M2 currency supply, what percentage change did they have from 1980 until today? Now, the numbers are somewhat different than what you just saw in those graphs because we used the intraday high of $52.50 instead of $50. So, So this corroborates that M2 scenario of inflation. And we've got the dollar is collapsing. If you take $100,000 worth of gold and it goes to $10 million, yes, the dollar is collapsing. But you can buy 10 times more cars with your gold that is pricing those collapsing dollars. It is the canary in the coal mine. And what happens during an event like when the dollars are losing value, and they have been, I can buy so much more real estate, stocks, just about everything I can buy more of today because I've been invested in gold and silver for so long. And other than cryptos, best performing asset of this century. And when you include cryptos, best performing, Bitcoin is up again. I don't know. Maybe it's not, but as of like a week or two ago, a best performing asset of this year, including cryptos. Mm-hmm. And so, yes, it is the dollar collapsing. That's part of the skyrocketing price. And that's the reason you've got to stop measuring stuff in terms of dollars. So I think the low range of where silver should go is that CPI number. That is like if we don't end up, I think triple digits is even inevitable without monetary demand. Getting to 100, 200, that still would not, compared to those other financial assets, that 200 wouldn't be in a bubble. The CP lie, the current one, the low CP lie, is just that. It's a lie. And so I would look at $200 as probably the floor of a predicted future price. When? That's the problem. I don't know. I know that, if you look at my first book, I made like 10 different claims in them. 7 of them came true. The other 3 have yet to come true, but they will. It's just taking a lot longer than I thought. 2015, so the price of silver is more than double what it was then. But still, that gives you an idea. And that 1980 rush, that's what a bubble looks like. That's when silver was in a bubble. It's nowhere near that today, but that day is coming. And I do feel that it'll be somewhere around $5,000 an ounce gold, where people will look at it and go, wow, this was $250 an ounce in the year 2000. I think, maybe the silver is a better bargain. Mm-hmm. They'll think there will come a day where they think gold is too expensive. That happened in 1979. Gold had gone from $35 to $400. And people changed their preference in late 79 from gold to silver once gold was perceived as being a little bit on the expensive side.
Investor sentiment, geopolitical conflicts, and macroeconomic factors influence the complex environment in which gold and silver are navigating. Silver remains relatively inexpensive and has considerable room for growth, while gold maintains its purchasing power and continues to enjoy robust demand from institutions. Supply shortages, industrial demand, and safe haven purchasing all support both metals, indicating that prudent allocation now could yield significant returns in the years to come. Investors will continue to need to keep a close eye on market variables, such as inflation, dollar swings, and international crises. How will central bank purchases and continued geopolitical tensions affect the price of gold and silver in the upcoming year? How can the price trajectory of silver change if investor preference shifts from gold to silver? Please feel free to express your opinions in the comments section below. If you found this helpful content, please remember to subscribe to remain updated and to give it a thumbs up. Thank you for joining us on this journey.
We're right at the end game. It could happen any month. It could happen in gold. It could happen in silver. I've always thought that it would happen in silver just because it's such a small market. Yeah, it's clearly a breakout. I would think silver is going to go at least to 50 and test that. I don't think longer term 50 is going to hold. I mean, we're going to go above 50, and then who knows what kind of numbers. And gold, I mean, there is no technical area or number because we're at all-time highs at this point, and just have to see where the next battle begins. But this is a breakout, and I view this as a worldwide vote of no confidence in paper. Even if we got to 45, 50 to 1, half of what the ratio is now, you'd be looking at what? $175 an ounce with gold at 3,500. If you got to 50 to 1.
Bill Holter warns that we're already at the end game, and a failure to deliver could happen any month in gold, silver, or even other commodities. And because silver is such a small market, a failure to deliver event could happen at any time. This move in gold and silver looks like a true breakout, signaling a global loss of confidence in paper assets. Silver seems destined to test $50 soon, but longer term it's likely to push well beyond that level. With gold already in uncharted territory, there are no technical ceilings, only the next battle lines ahead. If the gold-silver ratio simply returns to 50 to 1 with gold at $3,500, silver would reach $175 an ounce. Bill Holter, a well-known precious metals commentator and analyst, points out that recently, a big shift has emerged in precious metals delivery. Instead of contracts shrinking between the first and final notice days, more buyers are now standing for delivery, sometimes even doubling or tripling the original amount. This exposes the weakness of the fractional reserve system, where only a small fraction of the metal needed actually exists for delivery. As more people demand physical metal, the chances of a failure to deliver event rise sharply. Once that happens, confidence in the system could collapse, because contracts that can't be fulfilled are effectively worthless. Gold and silver prices have long been suppressed to protect faith in the dollar and the U.S. Treasury's ability to borrow trillions each year. By keeping gold down, authorities maintained the illusion that the dollar was strong. But that strategy is unraveling as major sovereigns are selling U.S. treasuries and shifting into physical gold and silver. This move reflects a deeper recognition. According to Bill Holter, once confidence in paper assets breaks, demand will rush toward tangible value, and the system will struggle to contain it. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
Right, it'll create more demand. And along with creating demand, not just paper demand, you're going to have more and more people buy contracts and then immediately stand for delivery. As a matter of fact, for the last 2 or 3 years now, it used to be, and I'll use silver as an example, it used to be that there were X amount of contracts standing for delivery on first notice day. And then by the time delivery day came, final notice day, the amount of contracts outstanding would have dwindled by 50% or more. Over the last 2 or 3 years, what has happened is you get X amount of contracts on first notice day, and then by the time of the last day, final notice comes, there's more contracts outstanding, and in some cases, there's more than double or triple the amount of contracts that were standing the first day. So you have buyers that have been coming in and immediately standing for delivery, and that's the Achilles heel to the fractional reserve system. I mean, there's no question. I mean, even the powers that be will admit, yes, it's a fractional reserve system. We really only have 5% or 10% of the metal or whatever it is available for delivery because not everybody stands for delivery. Well, we're at the point now where there's more and more understanding that because it's fractional reserve in nature, it will ultimately fail to deliver. And again, the psychology of human beings, when they're told they can't have something or they might not be able to have something, they want it even more. And it's going to cause a stampede of contracts standing for delivery, and that'll be your failure to deliver, which blows up the entire system, by the way. Because if you've got all these contracts that are actually worth zero because they cannot perform, it breaks confidence. And the reason, let me back up a little bit. The reason gold, and of course silver too, silver has been suppressed because they didn't want the fuse on gold lit. And they don't want the fuse on gold lit because if you've got $25,000, $50,000, $100,000+ per ounce for gold, that shows no confidence or a lack of confidence in the paper. On the other side of that, their confidence is absolutely needed in order for the U.S. Treasury to borrow the ridiculous sums that we've been borrowing. I mean, we have to borrow $2 trillion a year just to balance the books, just to keep the system afloat. So they suppress the price of gold and they'd whack it. I mean, you remember, go back, 10 years ago, 15, even 20, 25 years ago, gold would start to pop its head up and they'd whack it, 1%, 2%, 3%, which back then when gold was $300, $400, a $10 move in gold was huge. And it was demoralizing to see all of a sudden gold was going higher and boom, they smashed it. Well, the reason they smashed it was because they want to be able to point at the price of gold and say, see, gold bad, dollar good. And that allowed the confidence for the rest of the world to buy treasuries and fund the U.S. deficit. At this point, that's starting to unravel because you're seeing some very big sovereigns liquidating U.S. treasuries and turning around and replacing that with either gold or silver.
Bill Holter explains that gold's rise over the decades isn't just about a bull market. It reflects the steady decline of paper currencies since the U.S. left the gold standard. The dollar index may look stable against other fiat currencies, but the real measure is against gold and silver, and in that sense the dollar has been steadily losing value. Authorities have even considered gold revaluations in the past to reflate debt-heavy systems, highlighting the constant need to fight deflation with inflation. Today, as debt burdens balloon, the same pressure is building again. Governments must inflate or die. At the same time, silver stands out as the most undervalued asset. Historically, silver traded around a 15 to 16 to 1 ratio to gold, close to its natural supply ratio of about 10 to 1. Yet today the ratio sits near 85 to 1, even spiking to 120 to 1 in recent years. This massive gap signals extreme undervaluation, with silver priced far below its historical and natural balance. Bill Holter summarizes all the above discussion by highlighting that combined with its essential uses in industry, medicine, and technology, silver's position today suggests enormous upside potential once the market corrects.
I mean, this has been going on. It's been going on and on and on. I mean, we've had a bull market, if you will, in gold. But the reality is it's been a bear market. It's been a diluting market in the dollar and other currencies ever since we went off the gold standard. I would think if the dollar should be bouncing and bouncing pretty hard right now, it's not. And what won't go up must go down. So I think there's another leg down. But again, I don't think the DXY is really a good index to look at because you're looking at dollars versus other paper currencies, the euro, the yen. The true measure is versus gold and silver. And that verdict is already in. Right, because gold was $20.67, and then they revalued. They took everybody's gold and they revalued it to $35. And that, there's a lesson to be had there. When they revalued gold from $20.67 to $35, that started to break the back of deflation. It was an inflationary event. And I mean, there's all kinds of talk wherever you look now about a gold revaluation worldwide. Well, what is that telling you? It tells you that they're desperately trying to reflate the system. And they have to reflate the system because of the amount of debt that's outstanding. And it all goes back to the late, great Richard Russell, inflate or die. I mean, in this system, we cannot have deflation. You cannot have deflation of assets because everything is held up on margin. And when assets deflate, you get a margin call, then the entire system comes down. And basically currencies become literally worthless because they're based on the full faith and credit of the issuer. And all of these issuers, from the United States to all the Eurozone, I mean, they're all bankrupt. They're all upside down and insolvent. A lot of hedge funds and family offices, they're knowledgeable. Not all of them, but a lot of them have been buying the physical metal.
I see.
Now, that said, I can say that for the last 9 months, even close to a year, the demand for physical metal out of North America has collapsed. But yet the price of gold, I mean, if you asked me 5 years ago or 10 years ago, is there any way gold could be, could run from 2,700 to 3,500 and North America be a net seller? I would have said no way because, it would stir up the greed factor. But what you're seeing is liquidations out of North America and whatever. I mean, I've gotten I've gotten more sell orders in the last 9 months than I had cumulatively in the last 15 years. And I ask people, why are you selling? And I've only had maybe a couple, 3 people tell me, well, I'm going to take a profit. And I ask them, well, where are you going to put the money in a system that's going to mathematically collapse to keep it protected? And they're like, oh, well, when gold drops or silver drops, I'll go back in and I'll rebuy it. Well, good luck with that, because when there's a failure to deliver, there won't be anything to be had. And if you're not on the bus, you're off the bus and you can't get back on the bus. But the vast majority of people that I've asked have all said, I need the money. I need it to live on. So it tells me that the money on the streets in North America is evaporating or evaporated. Right, but they are both strategic metals. Think about silver. Think about all the uses that silver has: medicinal, industrial, technological, monetary. There's so many uses for silver, and it is, in my opinion, silver is the most underpriced asset on the planet.
Mm-hmm. Now, going back,
and I say that because, Danny, gold. The reality is, gold is the measuring stick. We got fooled. The world got fooled for 50 years that the measuring stick was the dollar. Everything was measured against the dollar. How many dollars? The reality is, dollars themselves are measured against the ultimate measuring stick, which is gold. Yeah, and the reason I say silver is the most undervalued asset on the planet, for how many hundreds of years, and even in the U.S. Constitution, the ratio is 15 or 16 to 1. You could go back 1,000. Well, first off, silver comes out of the ground just under 10 to 1 to gold. So there's roughly 10 ounces of gold pulled out of the earth for every 1 ounce of gold.
1 ounce of silver.
That's God's ratio. Right. 10 ounces of silver for every 1 ounce of gold. Now, for hundreds of years, the price ratio was 16 to 1. And the reason being, back 100, 200, 300, 500 years ago, in order to transport money, you had to transport gold or silver. But if you transported silver, you had to transport 10 times the amount of silver to get the same capital. So man discounted the silver price to 15, 16 to 1 to account for, the extra carts or carriages or whatever that you needed to transport silver.
In short, both gold and silver are flashing signals of deep cracks in the paper-based financial system. With debt loads soaring, currencies weakening, and physical supply inelastic, the pressure is building for a major repricing of precious metals. Silver, in particular, looks poised for dramatic gains once confidence in paper assets fades and investors rush toward tangible value. If a failure to deliver event occurs in silver, how quickly could it spread to gold and other markets? Could a government-led gold revaluation be the trigger that finally resets the global financial system? Share your thoughts on Bill Holter's analysis in the comments section below. If you find this video informative, please consider supporting us and turning on notifications to stay updated about our latest videos. See you in the following video. Thanks for watching.
Like, I personally have a price target on gold up near 15,000. Not tomorrow, not this year, but in the the fullness of time over the course of this bull market. $15,000 price projection is simply an average of the previous 2 bull markets, the one in 1970 through 1980, and then you call it 1999, 2000 through 2011. If you average the returns in gold through those two bull markets, that gives you about a $15,000 target. We're susceptible to a sharp pullback, that is true, but we're also, I think the path of least resistance is higher, up towards 50. And this chart here, this long-term monthly log scale chart, is kind of my roadmap. higher targets near 50 and even near 75 on this move. So, silver is respecting the technicals. Right here, there's this trim profits line. So for me personally, if and when we get up to there, which coincides with somewhere between 44 and 50.
The long-term outlook for precious metals suggests significant upside, with gold potentially reaching $15,000 over the course of this bull market based on the average gains of the previous 2 major cycles. While short-term pullbacks remain possible, the broader trend points higher, with silver showing strong technical support that could drive it toward the $44 to $50 range, and possibly even $75 if momentum continues. Steve Penny, a respected precious metals analyst, trader, and newsletter writer, explains that after gold first touched $3,500 in April, the forecast was for prices to move sideways with a slight upward bias for several months, allowing silver and mining stocks to catch up. That's largely what played out, with gold consolidating for about 6 months before breaking higher, while silver and miners began showing strong momentum. The key lesson here is strategy. Knowing when to buy is straightforward, but investors must also plan their exits. Bull markets are volatile, with sharp swings both ways, so deciding whether to hold through volatility, take profits, or actively trade is critical. Looking ahead, Steve Penny mentions that the dollar sits at an important support level after months of decline, which has boosted precious metals. However, an unexpected bounce in the dollar could trigger a sharp pullback in gold and silver, especially since gold is at its most overbought level on long-term charts since 1980. While the long-term outlook remains extremely bullish, with targets of $15,000 gold and $200 plus silver, caution is advised in the short term. The strategy suggested is to trim speculative mining stock positions as silver approaches $50, then keep cash ready to buy back on pullbacks. To ensure you never miss an update, don't forget to subscribe and hit the bell icon as we begin the video. We appreciate your feedback, so please leave a comment below and give us a thumbs up if you found the article interesting.
After the April peak, where we first tapped $3,500 in gold, my forecast, I believe we talked about this. I know it's been a little bit since we spoke, but I was saying, hey, I think it's very likely that we just kind of grind sideways in gold for a few months to maybe a quarter or two. And, that's not what people want to hear when it's just ripping straight up and stocks are going down. We want to hear to the move. Well, that was back in April. Well, April, May, June, July, August, now we're into September. So 6 months almost of just kind of sideways. And now we're finally breaking out. But my forecast was that gold would just kind of trend sideways to maybe with an upward bias. And that would allow silver and the mining stocks to play rapid catch up. And we're beginning to see that. That's finally coming to fruition. Now, as I share a couple of charts here, I just want a key takeaway from this interview is for people to think about your strategy. Knowing when to buy is fairly easy. It's when everyone hates it. But, everyone needs to have a personalized exit strategy of, are you going to just sit through the wild volatility? Are you going to take profits? Are you going to trade around your mining stocks? These are important things to think about, especially as things begin to move, because these bull markets are incredibly volatile. And we're seeing the volatility to the upside now. And surely as night follows day, there will be volatility to the downside as well. So the question is, do you want to sit through that? And here's kind of a basic roadmap I have. Now, I think any roadmap should be taken with a grain of salt because no one knows the future, right? But one thing charts help us to do is, make if-then statements and have a roadmap. And then we adapt as new information comes in. And when I look here at this long-term chart for the US dollar, what I see since 2008 is a gently rising uptrend. And where are we at right now? We're right at the lower rail of that uptrend channel. And of course, the dollar has been declining for several months now, for a while, and that's been a tailwind to hard assets, namely precious metals, silver and gold. Well, I think what a lot of people maybe aren't expecting is for a pop in the dollar, an unexpected pop in the dollar, and that could result in a sharp pullback in the precious metals. I mean, we've come really far, really fast. Gold on the monthly chart is now the most overbought it's been on the RSI since 1980. It's the second highest overbought condition ever. That doesn't mean it can't go higher. And I'm not saying that. You're talking to someone who's probably as bullish as you can possibly be. I just told you I think gold's going to 15,000. I think that's fairly conservative. Silver, $200-$300 or more. But at the same time, over the short term here, I think caution is warranted. So I'm certainly wouldn't be chasing, gold and silver here. But you can see on this dollar chart, we followed the roadmap so far, drew this potential path a while ago, and we've declined. Well, now here we're sitting right at the lower rail of the support. I could see some kind of exogenous shock causing a pop in the dollar. That just intuitive reactionary flight to safety, perceived safety, because you and I both know, the dollar should not, be a safe haven, but that's the knee-jerk reaction when panics happen. So I think that could happen. That could see a pullback in precious metals, and how you want to trade around that is obviously for you to decide. But for me personally, I plan to take a little bit off the table in my speculative mining stock positions as we move up towards 50, if that does indeed happen, in silver, and then have cash available to scale back in on any kind of pullback.
Steve Penny, in an interview with Liberty and Finance, points out that in silver bull markets, most of the gains often come in a short burst near the end of the cycle. While silver could face pullbacks, the technical setup suggests prices are headed toward the $1.44. That may be a good point for traders to take some profits in paper positions like mining stocks, while physical silver remains a long-term insurance policy. For gold, prices are already in a zone where trimming speculative exposure could make sense, as miners like GDX show extreme overbought signals despite gold being far higher than in past cycles. At the macro level, Steve Penny thinks that the Fed is under immense pressure as soaring debt makes interest payments unsustainable. Historically, governments always choose to debase their currency rather than default, and the US is no exception. With markets expecting a rate cut soon, the real test will be the long end of the yield curve. If long-term rates rise even as the Fed cuts, it would show a loss of control, likely forcing extreme measures such as yield curve control. That scenario would accelerate the bull market in precious metals, fueling even stronger gains ahead. Let's get the interview started now.
90% of the move in silver bull markets happens in the last 10% of the time. And, that may not be exactly numerically correct, but conceptually, I believe it is, where you get the biggest moves in the last part, of a bull market. I'm not saying the bull market is over, but my point is, right now, we're susceptible to a sharp pullback. That is true, but we're also, I think, the path of least resistance is higher, up towards 50. And this chart here, this long-term monthly log scale chart, is kind of my roadmap for hitting higher targets near 50 and even near 75 on this move. So, silver is respecting the technicals. Right here, there's this trim profits line. So for me personally, if and when we get up to there, which coincides with somewhere between 44 and 50. So the short answer is I think we're probably headed somewhere between 44 and 50, maybe a little bit higher. But I think that could present an opportunity to take just a little bit off the table in speculative positions. Now, I just want to give a caveat. When I say that, I'm talking about paper positions. I'm not talking about going to sell your physical. To me, I view physical as a generational insurance policy against these out-of-control central planners. I don't trade that. I'm talking about if you're into mining stocks, if you're into paper trading vehicles, that could be a time to take a little bit off the table between 44 and 50 in silver. That's kind of what I'm looking to do myself.
And as for golds here, do you have any price targets of where maybe taking at least some paper profits off the table would be a good option?
Yeah, so I think in gold, we're probably already in that territory. So one of the cool things probably isn't the best way to put it, but one thing about when you're in new all-time high territory, a lot of people think that's bearish. Oh, you're overbought and it's all-time highs. Well, that's actually can be bullish as there's now no overhead resistance. But you can use kind of like price projections and measured move targets. And my measured move target for this year was about 3,500. So we've already exceeded that. So I think this could be right around in here between 3,500 and 4,000. If you're in big gold miners, like you can look at a chart in GDX and that would probably be a good one to pull up. But like on the chart for GDX, we're getting extreme overbought and we're closing in within, spitting distance of the all-time high resistance at GDX. Now you can make a case, last time GDX was at this level, gold was $1,900 back in 2011. And here we are, $3,600 gold, and GDX is just getting back to that same level. So you can make a case that it slices right through it like a hot knife through butter. However, just from a purely technical perspective, we're getting overbought here, right now in the big gold miners. And before I moved on, I did want to just share this chart for GDX. This is that long-term monthly chart. And you can see, look at this RSI right here on the top right of the screen. I'm hovering over it for anyone watching on YouTube. The monthly RSI is at 80. That's the highest ever on record. Not like an immediate sell signal, but it's a caution signal. Kind of be aware of that. And as a general rule, when you get extreme overbought against clear, obvious resistance, typically you don't punch straight through it. So big gold miners, that just reinforces the case to maybe take a little bit off the table before, I think we're ultimately going much higher. So it's up to, individuals if they want to just sit through that volatility or, kind of use volatility to your advantage. I look at like the drama going on between the Fed and the president as kind of theatrics and a sideshow. It just highlights what you and I have known for a very long time, and that's Tina. There is no alternative. The Fed is between a rock and a hard place where they have to choose between sacrificing the dollar or sacrificing the economy. And history is replete with examples where central planners, those in power, always choose to debase the currency as opposed to default honestly. The federal government's in a situation, by the way, this is all governments around the world, every single one, 100% of them are in a situation where the debt is mathematically unrepayable. So they can choose to either debase the currency or default, honestly, and they never choose to default. So they're going to debase the currency, and that is just explanation for why there's such pressure on the Fed to lower interest rates and, make more easy money to try and kick the can down the road. Because the biggest variable, we're heading to a point, and this is something I think everyone should understand, we're heading to a point where 100% of our tax dollars, 100% go to just service interest on the debt. That's the trajectory we're on. And the biggest variable in that equation of how to kick the can down the road is lowering interest rates. So, no one wants this, currency crisis to happen on their watch. So how do you kick the can? Lower interest rates. And that explains why there's such pressure on the Fed. And I will throw something out there. The futures markets are pricing in like a 90% probability that the Fed will cut rates on September 17th, just a couple weeks from now. The thing to watch is, and I'm not predicting this, but it's something to watch, is the long end of the curve. Watch the 10-year and the 30-year and see if, as the Fed cuts rates, if rates actually go up. That would be an early warning sign that perhaps the Fed is losing control. If they're cutting rates and then the long end of the curve, interest rates rise, that would indicate they're losing control, and that would indicate that they're going to need to apply even more dramatic measures like yield curve control, which when that happens is just going to be like pouring gasoline on the bull market in precious metals.
Gold and silver remain in powerful long-term bull markets, with potential for historic gains driven by currency debasement, debt pressures, and shifting global demand. While short-term volatility and pullbacks are inevitable, the broader outlook strongly favors higher prices, making precious metals both a strategic investment and a form of financial insurance. Do you think the Fed will be forced into yield curve control sooner rather than later? At what price level would you personally consider taking profits on silver or gold? We'd love to hear your opinions, so please leave them in the space provided below. If this video was useful to you, please give it a thumbs up and remember to subscribe for more. Thank you for being a part of our journey.